Shanghai yo-yo. Can you make money on the downside? Beijing directs investment and IPOs. Speculation abounds as to how Chinese markets will spend the remaining weeks of 2007. The gloom and doom chorus continues to warn of collapse and remains critical of Chinese stocks believed overvalued. But the boosters say a year's end rally is already underway. What direction will the market go? One indicator of declines to come is the anticipated debut of index futures trading in China, thus giving investors for the first time a way to profit when Shanghai slips. When futures gets the green light is unknown, but Chinese regulators do like to introduce surprises, particularly when things look hot. In anticipation of index futures, ProShares, a purveyor of exchange-traded funds, or ETFs, launched last week the ultra-short FTSE Xinhua China 25 ETF, now trading on the American Stock Exchange under symbol FXP. ProShares was founded 10 years ago by two Washington, D.C. area securities professionals, Michael Saper and Louis Maber, and recently won approval from the U.S. Securities and Exchange Commission for its unique bearish ETFs. Here's how the new China ETFs work. The fund looks for daily investment results that correspond to twice the inverse of the daily performances of the FTSE Xinhua China 25 index that is composed of the 25 largest and most liquid stocks on the Hong Kong Exchange and was created by the joint venture between FTSE, the Financial Times of London and London Stock Exchange, and Xinhua Finance Limited. For example, if the FTSE Xinhua China 25 falls 1%, the ETF should rise in value by 2%. Right now, the ETF is invested mostly in financials, which are bound to be volatile, but also has exposure in energy and telecoms. Major stocks in the fund include PetroChina, China Mobile, and China Life, all currently traded on the New York Stock Exchange. This is an interesting new vehicle for investors in Chinese stocks where risk is limited to the initial investment and there are no margin calls. Additionally, ETFs have interesting tax advantages. As for the markets in China, it's a roller coaster ride, or yo-yo, depending on your frame of mind. The Shanghai Composite Index closed today at 5,462, up almost 5%, having plunged to a two-month low only 2 days ago. At least for now, 5,500 does appear to be a new baseline. The CSI 300 index was at 5,145.89 on November 14 and below 5,000 just yesterday, its lowest level in 3 months. Shanghai B shares closed at 344.76 today, barely up from its drop November 13 to 330, its worst performance since early September. Shenzhen Bs rose slightly to 721.42 from the slide that ended Tuesday. During the slide, the index hit its lowest level in almost 3 months. News from Beijing is the National Development and Reform Commission and the Commerce Ministry may restrict or even ban foreign investment in areas the national government feels are overheated and critical to China's national interests, specifically energy and mining. The new guidelines will encourage foreign direct investment in other key sectors. That gives investors clues as to where opportunities may arise over the next few years. The favored areas are environmental protection, including investments in fixing China's profound pollution problem and renewable energy technologies, and investment in high-tech, particularly advanced materials and equipment. One of the aims of the new foreign investment rules is to promote industrial restructuring of China's fragmented older industries, but that restructuring might better be helped by more foreign investment and strategic partnerships in the very industries to be restricted. The big news this week is the mega merger in Australia between mining giants BHP Billiton and Rio Tinto. The impact of the deal would be the creation of a de facto cartel in iron ore, as the combined Australian mining group and Brazil's CVRD would control about 80% of the overseas trade and be in a position to hold Chinese iron and steel makers hostage over prices. Rumors are flying that Chinese steel giants are trying to buy stakes in Rio Tinto, but companies on both sides deny it. China has voiced before to Australia the importance of forming what it calls strategic partnerships over a buyer-seller relationship. Ironically, merging BHP Billiton and Rio Tinto may free up assets in energy, and one rumor was that BHP advisors already went to China to market its petroleum and gas properties. Speaking of strategic partnerships, China's new sovereign wealth fund announced its biggest foreign investment yet, a $4 billion agreement with Bandes, the state development fund of Venezuela, for exploration in the oil-rich Faja del Orinoco region. As expected, PetroChina raised billions in Shanghai and its foreign-listed shares bounced back quickly from their much-talked-about brief dip. Bear Stearns got Warren Buffett's newsletter late, but is now telling its clients it's time to take profits. Alibaba finally debuted last week on Hong Kong, quickly tripled in value, then dropped on profit-taking. The company raised about $1.7 billion US, almost as much as Google did when it IPO'd in 2004. Shandong-based Sinotruk, which has a joint venture with Volvo, is expected to IPO in Hong Kong later this month, priced at 10 to just under 13 Hong Kong dollars a share. The company hopes to raise over $1 billion US to increase production of its large tonnage cargo trucks. And here's one for Europa. Asian Bamboo, a Chinese bamboo products company, will IPO on Frankfurt November 16, has moved its headquarters to Hamburg in anticipation. The company's young founder, Lin Zuo-jun, hopes to raise up to $180 million US to lease new plantations in Southeast China and fund a bamboo flooring factory. I'll see you next time.